Thank you. You know, you heard in the introduction right now the enormous challenges and particularly the complication of any economic system, and many Mr. Montes have been tried in the world. Virtually everything you have been sort of directing to has been tried one way or another, but we all know that we have not yet found our paradise. We have not yet achieved what probably everyone would like to achieve, which is solidarity and the well-being of all nations and their subjects in this world. When it comes to finance, things get even more complicated. And I always say I hold myself to the word of the Nobel Prize winner Samuelson, who wrote the basic, probably in modern economy, the basic book, where he always put a little paragraph in front of each chapter, fiscal chapters of the economy, labor. And when he came to money, he said, out of 10,000 people, only one single person understands what money is. But that person we meet 100 times a day. And that's how we very often feel. I think since 2007, 2008, and the deplorable collapse of the financial system, I think you have, as I did, read 1 million, if not 2 million, if not 3 million opinions, what should be done, what went wrong, who is to blame, and obviously now coming from an industry who has caused, at least is certainly guilty of some of the excesses who led to the collapse, it is very difficult to represent with some credibility the situation as we see it. But let me remind you that until further developments, we are living in a system in which capital, money in all its forms, plays the central role. Not unlike the blood circulation in our bodies plays a central role. And to make it very simplistic and simple, that we all know from the medical world that if we have infection in one part of our body, and that infection is not ring-fenced, is not treated rapidly, up to the point that some of our bodies might be amputated, these infections always result in poisoning of the entire bloodstream. And that's what did happen to us. Infections which initially could have been treated relatively easily were allowed to infect the entire bloodstream. And I can obviously use different examples and can tell you that blood does not reach our left foot. Inevitably, that left foot will have to be operated on, and the blood streams will have to be restored. I can equally say that land, which is not irrigated by water, will not result in crops, will not give us what we expect from it. Therefore, I pretend that without capital flows, without the irrigation of capital of all business activity, business will not prosper. Economies will not grow. Areas will not be developed. And the necessary balance in this world will not be established. For years, Mr. Montes knows this very well, capital flows were not free, but controlled by government. Yes, worse, they were imprisoned. And every country was jealously guarding its own wealth, would not allow its savings to flow abroad, to look for better investments. No, governments were allocating these funds within their own country, within their own regions, within their own industries, and obviously all these decisions were based on political priorities. That's what happens when you let government allocate credit. That's what happens when you prevent credit from flowing freely across borders. Over many years, but particularly after a very slow period of economic growth in the 70s, once the Bretton Woods system had outserved its usefulness because it did serve the post-war economy extremely well, it did allow the rebuilding of the economies after the war. But once it had outserved the usefulness, we went through a very difficult transition period. And after that transition period, it was a very dogmatic approach of Mrs. Thatcher and President Reagan who changed the economic system in the sense that dogmatically they were advocating free flows of capital around the world, deregulation and liberalization in any aspect of our economic undertakings. This did create, or probably was the last big confrontation with other systems in this world who continued to advocate that governments should allocate scarce resources, and governments, their politicians or their leaders, depending on the system, should decide what was important for a country, what was not important, which economy should be supported, which industry should be supported, and how their citizens should live and deal with their savings. The 80s and 90s brought to us a new element which Mr. Montes rightly mentioned right now, namely competition. Because liberalization, deregulation in a system does create competition. And as usual in competition, some succeed rapidly. They're winners, they are losers. There are companies who prosper, there are other ones who lose. There are companies who adjust, there are countries who adjust. Other ones do not adjust. They stay cemented in their old system. They cannot adopt for reasons which might be totally different. They might have to do with the way they live. They might have to do with their culture. They might have to do with their religion. But we went through this long period of deregulation, liberalization, and the inevitable competition which goes alongside. I want to pretend today that with the establishment of free capital flows all around the world, in varying degrees, but nevertheless overall free capital flows, I would pretend that these free capital flows were the savings of the world were circulating and being invested from Buenos Aires to Mongolia, seeking the best risk-adjusted returns, that it was this capital which did lift billions of people out of total poverty. And I don't have to remember the ones here who have with me past many years of the end 20th century with all the government programs, with all the United Nations programs, with all the help of the World Bank and other international institutions, trying to allocate funds to these then underdeveloped countries, which today, rightly, are either called emerged countries or emerging countries, which is a huge difference from being called underdeveloped countries. And I want to pretend as well today that all these government efforts in the 60s, 70s, 80s had failed. And what had failed over 30 years was achieved by free capital flows in virtually 10 years. Yes, it did create problems. Yes, we had the South American crisis. Yes, we had the Asian crisis. Yes, we had after that a Russian crisis. Yes, we did have a crisis of over-leverage. But, ladies and gentlemen, there aren't enough savings in the world if I take dollar per dollar or euro per euro or whatever currency you want to use. Without credit, without leverage, there is no way we can satisfy the aspirations of billions of people around the world to a better life. There is no way that we can finance the enormous task Mr. Montes rightly mentioned, the long-term investment. It takes, in a country like Switzerland, with all its experiences, 20 years to build a tunnel through the Alps. It takes $50 billion to build a tunnel through the Alps. We are here with Mr. Yakunin. He knows better than all of us what it takes to build a modern railway system and aspire to the demands of the economy and the people of a country as big as Russia. It takes hundreds of billions in order to establish an electricity supply system which lives up to the expectations of our economies. Yes, it takes trillions of dollars. It takes trillions, let me be very clear, of your savings. It's your and my savings. There is no growth, there is no leverage, and there will be no credit without your savings. And I'm always the most amused, and I say it without hesitation, when I hear the taxpayer had to bail out the banks. No, the taxpayer was bailing out himself. The taxpayer was bailing out his deposit. That the banks have been the ones who had failed to manage these deposits properly. That the bank managers had horribly failed in their tasks, their duties, and their responsibilities is a different matter. But the taxpayer was not bailing out something abstract, no. The taxpayer was bailing out himself, and that's why government immediately ran to the help of these institutions. And the idea that you just can let it all go bankrupt and everyone loses its deposits and its savings and its pension and its insurance policy is obviously something we wouldn't look for. So I think a lot of ideas are circulating in the world which are not necessarily being thought through. To come to your subject on solidarity, it is very clear and has been proven once again that the money business, the working with other people's money, the banking system, is much too important to our economic well-being to leave it alone. It needs strict regulation. It does need a framework in which it operates. It needs consistent controls because money will always be subject to speculation and to manipulation. And when I come to solidarity, I want to stress something else. There is an idea here, and within the broad and the heads of the population, very often entertained by politicians, that there are dark forces at work who sit in London or in New York or in Washington or for that purpose in Paris and figure out how to use money to reward or penalize, to withhold it from entire countries or withhold it from entire industries. And these are planned conspiracies. And I don't have to point out for the ones of you who have looked at history, who have seen the rise to power of the National Socialists in Germany, who used with the greatest and consistent repetition the word international financial conspiracy. And needless to say, they always added the word Jewish to that. They believed that there were these dark forces who were working hard to keep Germany down, to let Germany never recover after the First World War, to keep this economy under terrible capital stress, because, just to remind everyone, the situation some countries are in Europe today was the situation Germany was in 1929. They were the biggest debtor, and they were not able to handle their debts properly and achieve economic growth at the same time. I am only mentioning that you understand, and we testing ourselves time and time and time again, whether there is a general manipulation of markets which does either allocate credit and capital or withholds credit and capital. And I can assure you, there is not. And I can assure you that liberalization and deregulation has created a financial system with so many participants that even if someone would try such a manipulation, he would not succeed. It is too difficult. And there we have the advantage of competition. Such competition does not allow acting together, acting in collusion in order to allocate credit around the world. It is true, it is for sure, that money and capital is one of the most extraordinary weapons which could be and can be used. It's a weapon of protectionism. Protectionism is not custom duties. Protectionism has many, many faces. Money and capital is one of them. But let me assure that in the last 20 years, with success and with the disasters and with the losses, money and credit has been allocated by free markets. Money and credit has been allocated by individual decisions and not in general by any kind of conspiracy or plan to either help or penalize other countries. Let me equally say that new regulation, with all the capital requirements, with all the safety which is now in security, which regulators, governments try to build into the system, that's where you all have to be careful and watch carefully. Because, yes, credit will be allocated now on very strict capital usage criteria. And here, there will be many criteria. Yes, there will be the rating agencies. Yes, there is totally underlying capital needs for different investments, for different credit allocation. Yes, that's where things can become very critical for emerging markets, for the simple reason the capital needs to do a transaction in emerging markets or in upcoming industries which do not have the solidity or the ratings or the balance sheets of the past will be much higher. Therefore, much less desirable therefore much more costly for the banks, and therefore the banks will ask for much higher returns, which means nothing else than money and credit for these kind of debtors in the world, whether industry or countries, will be much more expensive. And therefore, by definition, putting countries, in that sense, at a disadvantage. And I can only say, when the word, not just to distribute what others have, and to expect that what others have achieved in hard work to be distributed in a fair way. Solidarity has to be stretched, particularly on values. We all will have to agree how this world should look like. We should set the overall conditions and the framework, and then compete peacefully within that framework. Thank you.
Thank you very much, Mr. Rudloff. There are many questions. I can probably only take 3. But if you're all very short, we might be able to take some more. But I'll start with Vladimir Popov. And as I said, please keep your questions and comments as brief as you can.
And by the way, you can be as provocative as you want to be, because I did address university students 2 weeks ago, and I think I have heard it all.
Thank you so much. And I will use the chance and try to be as provocative as I can. I'd like to comment on one of your statements and to challenge one of your statements. You said that free circulation of capital from Buenos Aires to Mongolia is something that lifted many countries out of poverty, millions of people out of poverty.
Billions.
Even billions. Probably you mean China, and let me start with China.
No, I don't mean China. I just said
maybe
billions
India.
Around the world.
Otherwise,
anyway.
we don't get billions. If you don't take China and India, we don't get billions of
Well,
people.
India is something else.
Now, if this is China and India, these are the countries that had the success in recent years, and as we know, success usually have many parents, and failure is usually an orphan. So now, many people claim that there was a contribution of Western capital to the Chinese success. I would argue that the Chinese success comes from the mobilization of domestic savings. And even more so, China is so successful in mobilizing domestic savings that China is sending the savings to the United States, keeping the American economy afloat, as we all know. This is capital flowing uphill. All economic successes in recent 50 years were definitely based on mobilization of domestic savings. This is what we mean by economic miracles. Probably the first and the last successful program of external financing that led to economic success was the Marshall Plan. In the words of Joseph Stiglitz, he said, I wrote 10 years ago that free movement of capital does not contribute to economic growth. He meant short-term capital. He said, I thought, I'm not a specialist in the field, I thought my colleagues economists, my fellow colleagues economists will come to me and will show the articles which prove that short-term capital movement, free movement of short-term capital contributes to growth. Nobody came, and I conclude that we don't have a solid evidence that short-term capital contributes to growth. On the contrary, we have the solid evidence that short-term capital contributes to volatility. When you said, yes, it contributed to the crisis in Brazil, yes, it contributed to the crisis in Russia, yes, it contributed, you know, the list was pretty long. So I guess my question would be, can you point out to economic success story that was based on the external financing? Thank you.
Yeah, we can point out, and that will be a long story, and I think it's not the point. If you question the benefit of trillions of capital flows into emerging markets since 1990, well, what can I say? That in the meantime, these trillions of investments, these trillions of flows have achieved results we don't doubt. That China is a special case, India is a special case, Indonesia is a special case, Russia is a special case, everyone is a special case. But if you think the world would look like it looks today without these trillions of savings which have and did flow in these countries, then, well, let it be a debate based on statistics and so forth, and would be only too pleased to do that. But I just refer you to the World Bank. They will give you all the necessary statistics. Now, having said that, capital flows have many faces. One face is direct industrial investment, enormous capital flows, but at the same time, experience, technology, skills, and all the other things which go with it. Yes, you have short-term speculative moves. Let me just tell all the countries who are represented here, it is up to your authorities to deal with short-term speculative moves. It's not up to the capital who's being invested. Yes, short-term capital moves are always somewhat dangerous because they come and they go. They create illusions and they disappear. But once again, it's up to the countries to use the capital when it comes in. It's up to the countries to establish the conditions which prevents the capital who came in to leave again. And if you come to the Asian crisis, subsequently Russian crisis in 97, 98, yes, Korea, South Korea, to take the advantage, borrowed $200 billion short term. Not exactly a cautious way to go about financing. So yes, there will always be deficiencies. Yes, there will always be mistakes. Yes, there will always be exaggerations. Yes, there will always be speculators who look for short-term success and short-term money. But yes, at the same time, they're always long-term investors. Yes, all emerging markets have extended the maturity of their borrowings dramatically, from 1 year to 10 years, to 20 years, to 30 years, and once again, Russian Railways is just one of the examples. Yes, short-term money is flowing, but yes, long-term money is flowing as well.
President Der Kühnen.
This is funny. Hans mentioned several times Russian railways. This is not because he is studying Russian railways.
Because he mentioned infrastructure.
Yeah, but because we are long-term friends, and he knows about my intentions, and we discussed many times many things. But now, Hans, I would like to be very particular. You mentioned several things which cause some questions. You mentioned free market economy, but we both know that since maybe 30 years ago, there is no free market economy in the world. Statement. Changed. Secondly, you mentioned free flow of the savings. But when we have the total economy value of $60 trillion, while derivatives of $600 trillion, what are the savings? Those, some virtual monies, not reflecting the values of the real economy sector. Peter Loesch and myself, we are getting our salary and bonuses because we should introduce high efficiency of the manpower, decreasing the cost, and introducing bridges, trains, tunnels, whatever. This is not virtual, this is material. But when we are talking about the free flow of the savings, if there is no savings, what we are saving and what we are getting into this chain of blood circulation. We cannot imagine the circulation of the blood without material body. So the entire pyramid is now upside down, where in the basis is this financial system, not the economy itself, not the real sector. So it caused many, many problems when we are talking about solidarity, not solidarity economy. So that are the questions. Free circulation of non-saved monies, free market economy, which does not exist, what we are heading to. Thank you.
Okay, well, until I want to be very clear, until the early 90s, there were no derivatives. So let's just be very clear on that point. That when it comes to derivatives, which are today being described as the instrument of the devil, let me just make one point. The instrument is neutral. The devil is the one who is using it for good or bad purposes. There is no modern economy possible anymore with a no financial system without derivatives. For the simple reason, all companies, whether it's the best one in the world like Siemens, the highest rating one, everyone in our life is using derivatives. It's just another word for creating leverage. And here I'm the first one to be as skeptical as it has been mentioned, because the financial system, and let me, in order not to say regulators and governments, did allow unlimited leverage. And even today, a ratio, let me be very clear, if you buy gold, if you buy diamonds, if you buy anything in this world, your margin requirement today is 5%. That's all it is. In other words, you buy something for $1,000 and you pay 50. And needless to say, the slightest move in the underlying instrument will create you big gain or big loss. Something people, institution, and our human nature has a terrible time to resist. It's a temptation which is always with us, and therefore it does need strict regulation and intervention. And the one thing everyone forgets is the biggest measure taken after the crash in 1929 was a leverage ratio change, which meant that from the day on it was introduced, people had to pay 50% of what they were buying. Whether they were buying a house or a share of IBM, 50% was the minimum real money and real saving which had to be put on the table. The equivalent rate today is 5%. And needless to say, if someone wants to have a more solid system, a more balanced real economy, real savings, real underlying, we need totally different leverage rates. Equally, we will not be surprised to hear there are very strong forces who will fight these ideas, because there's nothing better to make money with than leverage. But I don't dispute the excesses in the financial system. I belong to a few who warned against it. I did have the opportunity to express myself as I was the head of the International Capital Market Association with many central banks, as well as many politicians. And I have to tell you, nor in 2005, nor in 2006, nor in 2007, we were very successful, because it's very difficult to stop trains which are running towards the paradise, at least in the minds of people. And that's what happened. And the accident has occurred. The opportunity for serious correction is now being given to us. People have been unbelievably penalized. I am well positioned to tell you that out of our 11 executives at Barclays, we lost in the last 3 months 6 of them. And, well, good or not good, the only point I'm making is it is not that the penalty has not occurred. It is not that the bankers have retired to the nice beaches of Greece and enjoy their life.
Where is Bob Diamond?
Well, where he is, he's nowhere right now, as you know.
I know.
So people, and by the way, he has been one of the better bankers in the entire system, but he is as well honest enough to take the blame for the organization he was running. But let me say one thing. When derivatives were introduced, an old professor of mine, a consultant to the then firm I worked for, and a former member of the Federal Reserve, came to me and he said, Rudloff, I will tell you something. You know what derivatives are? Derivatives are the same like taking a bicycle and put a jet engine on the bicycle. It will go up like this, and when the fuel will run out, it will come down like that. Well, that's basically what happened. We learn from it. Regulation will adjust to it. There will be a better system, and if anyone wants to know my opinion, I don't belong to the one and say we need Glass-Steagall. As much as I will not say we are going again to go across the Atlantic with sailing boats. We need the principles of Glass-Steagall. Yes, we do need protection of deposits. Yes, we do not want to have deposits being abused through speculative activities. Yes, we have to reorganize our banking system. And yes, ladies and gentlemen, it's being reorganized on a daily basis. But at the same time, it has to be reorganized in a way that it doesn't collapse under our feet. Because credit is still the fuel which keeps our economies going. We have to keep it going. This is a difficult rope to work on. Yes, we do need more morals and ethics in the system. Yes, abuse has occurred on a daily basis. And yes, we all have to work on our own responsibilities and try to do things better than we did in the past.
I'm going to be unpopular with many of you, but I will have to cut it short here because for reasons of fairness, we have to move on to the other presentations. I do hope we have time at the end of this session before coffee break to come back to some of the questions that would have been raised now. But for now, thank you very much, Mr. Rudloff. Can I now invite, and I apologize for my